Hello and welcome to this episode of Young and Visionary with me, Esnat Suleiman. This will be part one of a series on the topic of the investment life cycle. Now, for those of you who have been following this page for quite some time, I'm sure by now you're aware that my regret is that I never started to invest early. So I'm a bit passionate about this particular topic because this topic will tackle what you should be investing in different stages of your life, perhaps the circumstances that are surrounding you at any point in time. Of course, taking into consideration that people are different and therefore will be going through different circumstances, but the overall picture will pretty much be the same. So stay tuned. So first of all, I will talk about the first phase, which is mostly referred to as the early accumulation phase. So if I were to look at the demographics, I would put this phase to be between the age of 20 to somewhere around 35. So people in this stage are in their early years of their career. If they're into business, they are also in the early stages of their entrepreneurship journey. If you look at this stage, this is the stage when you are pretty much just starting off. Your income may probably be on the lower side. You're probably maybe also just starting a family, so you have a lot of obligations. Normally also in this stage, you're quite indebted. So maybe you have a car loan, maybe you still have a student loan. If you got your mortgage early, you probably also have mortgage payments that you need to look into. So this is a phase where the demands on your money could be quite high, but it is also a stage where you are young and you can take more risk. So when you look at your investments, you need to be looking at taking a bit of risk with the potential of making more return. So you can push yourself, make sure that you're earning a good return, but with the mindset that if you do make a loss in the process, you're still young and you have time to recover from it. When I look back to when I started investing, I was also within this very same age range. It was very difficult for me to start investing because I had a lot of responsibilities, so therefore a lot of obligations. In addition to that, I had a loan for a vehicle. I think I still had my student loan at that time. And towards the end of this phase as well, I also had a mortgage. So I really did have quite a bit of obligations as well as personal responsibilities. And I always gave myself a good excuse not to invest. But having worked in the investment industry, I was able to appreciate the importance of investing. And how I started the journey was really to just get an investment policy. I remember at that time, the first policy I went for was 5,000 a month. It may not sound like a lot now, but then it was a lot of money to me anyways. And it was me testing the waters to see if I could afford to take a 5,000 out of my salary every month. After a while, when I noticed that it was going well, I then increased and got another policy for 15,000, so making a total of 20,000 a month. So what I'm trying to say is, in this first phase, you may not be able to invest a lot because you also have a lot of demands on the money that you're receiving. And because of that, it's very easy for you to make a decision to say, I cannot invest. But this is also an important phase because this is a phase that sets the tone for the rest of your investment life. This is the phase when you can develop the discipline to save. So it's not about the amount, it's more about the discipline. And if you can develop the discipline this early, when you do have substantial cash flow, when you do have reduced obligations, you will easily be able to save because it would have become a part of your lifestyle, a part of what you do. So I do encourage you to do a bit of budgeting. look around the different responsibilities and obligations that you have, and decide on a reasonable amount that you can invest every month. I'm stressing on the word reasonable because if you put it too high, it will be very difficult for you to be consistent. Remember, the target is to achieve consistency. So you should make sure that the amount is reasonable, an amount that you can put away each and every month. The other thing that I wanted to speak about are now the type of assets that you would be investing in. So, as I indicated earlier, in terms of the obligations that you might have, they will all demand your cash flow. So some of you, if you have children, you're paying for their school fees. If you have a loan, you're looking at your interest repayments or maybe even your capital repayments on those loans. So when you're putting your investments together, what you want to do first is to work towards creating that emergency fund. Because at this stage, you will run into some emergencies, and you want to make sure that you have an emergency fund that you can easily tap into to be able to meet those obligations. You may not always have someone that you can rely on to get a short-term loan, for example. So building the emergency fund is the thing that you should target to do at the very beginning of your career. The second thing that you should also do is to make sure that you create a balance in terms of your long-term investments and some short-term investments. Like I mentioned, during this period, you have a lot of cash flow requirements. You're making interest payments on your loans. Maybe you're paying school fees for your children. You're really just trying to accumulate. You're trying to buy furniture for your house, a fridge, a cooker, whatever it is that you need for yourself. So you will need to maintain a certain portion of your investments in liquid assets. So these liquid assets are assets that you can easily convert into cash as and when you require. Examples could be a fixed deposit, an investment in the unit trust, a repo investment. All of these comprise liquid investments. But if you recall as well, in the beginning, I indicated to say that at this stage in your life, you can take a bit more risk. So this is also an opportunity for you to push your investment returns. So another thing to look at are your long-term investments, sort of like the shares on the market. So in selecting your shares, you'll be looking at shares that have great potential for price gain. So you look at the prices of the stock on the market, you look at the valuation ratios, you look at the size of the company, you look at the industry, you look at the opportunities for that company to actually grow long term, and you make your decision in terms of which stocks to buy. So when you buy these stocks, these are the stocks that will help to really multiply and grow your money as you're going through this first stage of your life. And that was part one of the investment life cycle. I do encourage you to make sure that you do watch the rest of the episodes that will follow on this particular series, because even if you're only 25, you need to be able to think ahead and know how you can plan your investment journey to reach retirement. So make sure that you go through all the episodes, even if you only have one episode that is applicable to you. So stay tuned.